Hi, welcome back to our event. And we're now going to have, in our new latest panel, we're going to be focusing on pricing optimization strategies in retail finance. For that, I have with me Marcus Looft, who's extremely experienced in this area with a deep experience in insurance and the whole pricing and pricing optimization arena, if you will. Marcus, if you could introduce yourself.
Thank you, Sid. Yes, Marcus, I'm have to almost like now, not almost, I'm more than 25 years in the industry, in the financial industry. Actually, on all sides, I was on the financial carrier side, I was on the consulting side, I was on the service provider side. I've seen many different angles there. Even was able to start my own insurance business in Switzerland, where we actually implemented quite new and quite massive pricing regimes, and therefore I'm happy to talk with you about all the kind of environmental things around price optimization.
Fantastic. So with that, let's dive into our subject of the subject now, if you will. So price optimization by finance companies. What does that mean for? What does that mean? What is the ecosystem? What are the key issues and challenges there? Just to set the scene for our conversation today, if you will.
Yes, sure. Yeah, I think from my experience, I have seen price optimization or some form of optimization also for processes in general when there was, first of all, of course, data, and you could justify what you did, and also that you could do it really. So you had to have an architecture that really was flexible enough to make it happen. And when you think about most of the carriers, there are often lots of pieces of these ecosystems. So you have, like, of course, client legacy system, policy systems. You have third-party systems like marketplaces, comparison platforms. You need to have flexible analytics execution platforms such as pricing engines, and data enrichment providers have become more and more important over the last couple of years. So this could go from very simple things like you need to add data to the offering of the client, like in the case of car insurance, or you need to ask a credit score or any other third party. And all these things have to put together by the responsible people. So you have you need to have a strategy where actually the client view, the provider's view, the partner's view, and their interactions are very well orchestrated so that there are no irritations and everything looks smooth and a good experience, so to speak. And oftentimes in banking as well as in insurance, you need to handle and manage more of these ecosystems. So sometimes you have partners that require manual interplays or are more digital, and everything has to be actually very, very smooth so that from the client perspective, it doesn't feel to be treated differently. You should not have this feeling. And therefore, there's always a common denominator, common language that you need to adhere to and to make it really a good journey for everyone.
This is clearly a very complex environment. There are many providers. There is data enrichment providers, etc. But I want to look at another aspect of that environment, if you will. How does regulatory environment drive or inhibit the sort of growth in price optimization? What are the challenges and maybe even pushes that regulatory environment provides, if you will, in your experience?
Of course, that's a very important one. And to me, or my experience, sorry, did you want to add?
No.
Oh, yeah. So in my experience, we had seen both sides. Regulation was relaxing and regulation was tightening. So it was relaxing in the 1990s for banks and some pieces of insurance and some regions, not all regions the same, all over the globe. And when these things happened, oftentimes when you relax the situation in regulation, of course, there is a benefit to clients. That's the main purpose or the main reason why regulation relaxes. You would like to see more competition. You like to see more creativity. Also, you oftentimes invite new players into the market. So there's a benefit for clients in the beginning, at least. But then also the companies react to that. And oftentimes for them, the situation becomes harder and it's a harsher environment. And so they also react to this situation, and they can react in different ways. In some ways, they did price optimization, meaning that the competition was higher, and so you need to have a better and even more precise pricing. And then, of course, it can also go the wrong way. So when you have too loose regulations, and we have seen that for example, with the mortgages in the 2000s, that then the initial benefits for clients turned actually into a curse for both the clients and the providers. So I'm not necessarily saying, oh, price optimization, a loosening or relaxing of regulation is good. I think the regulation has to be very wise in what to say and what to state, and it can go both ways. And what we don't want as providers and as clients is actually like a ping pong effect. Like you're starting with too loose regulation, and then you find out, oh, that's too loose. The initial benefits swap or switch, and then you have to be too harsh, and then also the situation is not perfect for clients and not perfect for the providers of services.
Would you
And in any
rather say that regulations need to be stable? Because first of all, the challenges that you brought out, but also your previous point about the fact that it's a complex ecosystem. You need a lot of integration. You need to set up systems. You need to take in enrich data, and you need to set up your algorithms. So stability is a key issue. Would you say that?
I agree, although I don't want to blame anyone in regulation, because to find those is a very challenging task. And we have seen that you have to be very wise, you have to be very anticipative or anticipating of what will happen in the future, because it's a dynamic thing. And so we can never have these kind of ideal regulations. But you are right in terms of investment. Even providers don't want to see this kind of change it back and forth between regulation, because that means you have to change many things, and oftentimes the flexibility that you try to have and you always want to have, that might not be enough to adopt to the changes, really. So a stable one, or like some proactive one where everyone speaks about it, and you have a plan for the future. How would we like to continue together as a society is the best thing to do, I think.
No, clearly, hitting the sweet spot in regulation is one of the hardest things. I mean, it's it's nobody can decide the future, and so what happens in the future, it's difficult to know. But I mean, the thesis that I think I took from you is that stability is even more. I mean, just you can't get it perfectly right, but the more stable it is, the better it is for both customers and the carriers and everyone in the system, if you will. But let's now focus specifically on insurance, if you will. I mean, sort of moving from the general, if you will, general price optimization techniques, methods, and overarching environment. Let's look at the sweet spot that you've been involved in for such a long time. If you could talk a little bit about the dynamics in insurance and where the trends are, what the state of art is, that would be really interesting.
Of course, yes, very much so. I mean, I cannot speak for the globe. I mean, my experience was more in Europe, and in Europe we had a very kind of keen move, or like a brave move in 1994 when the EU decided to relax or liberalize the P&C market very much. And I think we have seen the most innovation there in this region in terms of different products, lower prices, better coverages, even sophistication in pricing, hiding pricing from the competitors, and also the need for hiding them, not to have the antitrust problematic in that way. So there was quite a game, like I would call it chess game in a way. So you had the insurers, they were trying to maneuver. You had the clients that also maneuver. Everyone thinks the other one is in a better position. That's very interesting from when you look from afar. And of course, then additionally to this liberalization came the internet and the price comparison aggregator market, and that has given another spin on this thing and has created an enormous analytical deep dives on the insurer side. And you often could see that there are always providers that actually offer prices for almost everyone, gets a price that really is not sufficient to cover the risk, to cover this cost that is associated with this. And on the other side, also the insurers, of course, they see it on the other side. Yeah, the insurer is the expert, and I can only change my insurer, and this is a cumbersome process, and I don't want to change every year. Some do that, some don't. So, and they also from their side sometimes don't want to see unfair treatment, unfair price changes and increases oftentimes. And so from this, there's again this ping pong effect, like very liberal, very loose. Then of course everyone sees, oh, that's quite, we all have to battle in a way, so client and provider. And then there is a tendency now that insurers started to restrict themselves. The EU restricted insurers, and also the insurers restricted themselves to say, okay, we cannot use certain rating criteria because that's unfair, that's discriminatory, and so trying to avoid things in the pricing, so to keep like a fair deal for everyone. So there we see a swing back as well, I think, from very liberal towards probably again tightening regulation a bit.
And do you think that when you mentioned the internet being an enabler, but do you think also the fact that during the same period that you sort of were talking about, the computational capabilities massively grew? So the fact that you can do a lot of these algorithms fairly automatically and can leverage uh, um, the rapid growth in computational capacity was a significant driver for the carriers to provide more sharper price discrimination, etc.
Absolutely. You had to be, as you say, you had to be more precise, and more precise in an environment that is very diverse means a lot of complexity. So the complexity exploded actually, like really that not humans, not actuaries could do the work any longer because the massive amount of coding, so that everything had to be scripted, like not even having AI or machine learning models, but just to enable those models means to script them and to script the way they are executed. And that has like from let's say a piece of paper in the old days where you had a very nice and sophisticated good tariff and good rates, towards like gigabytes of data to be considered when you set your prices. And there we see all these kind of crazy things that happen when dynamics take place, and have to be managed and have to be very well controlled as well. Yeah.
As you start becoming much more analytical, is there a challenge in how you build in fairness into the algorithms, how you build boundaries and constraints into the process?
Yeah, I think we actually, when, for example, you I mean, we do statistical mistakes in pricing all the time in statistical models, and oftentimes that's because we just have our own data. And when you look around, and or like in game shows where you ask the audience, you get mostly the best answers from the audience. And the same happened here these models look around the machine learning and try to understand what everyone else does, and then oftentimes that balances things and makes things more precise. Can also go the other wrong way. So we have seen that on the stock market, that all the machines, they drive everything into ruin, so to speak. That shouldn't happen, and therefore the control and the sanity that humans have to sit in between. Still, I believe that is important, so that not these vicious circle appear, but actually stability, what we spoke before. And stability sometimes comes also from large data and large analytics. Yeah.
Right. And then just switching very quickly to other products, thinking about other products such as mortgages. How do you see the challenges there and the differences between, some of the mortgage and insurance markets and some of the big structural issues and themes that you've seen there?
Yes. So it's again, like, I think a game of regulation and the players and the market. And to be honest, we have seen there are also extremes in the past. I don't want to dwell too much into that right now, but now currently, for example, in Europe, because of the long period of low interest rates, everyone expects to have a property, a house bubble in a way, because the rates are too low. And I think for carriers, it's hard against this trend to say, okay, let's stay on the conservative side, because we also need to survive. If everything crashes, then no one is happy. The house owners are not happy. The mortgage or the lenders are not happy. The society is not happy. So I hope that again there is some kind of sanity in applying these methods to say we need to be on a healthy path and maintain a healthy path. And as an outsider, I'm not a super banking expert, so everyone excuses if I'm stating something wrong here, but that's my outsider view, let's say.
No, that's very interesting, and in many ways, you're making a case for having the regulator take a little bit of focus when the markets become exuberant and become more dynamic and volatile, if you will, in their sort of to take the punch bowl when things are getting rather exciting, if you will. Now, moving from there to sort of the core points about the issue of data and data management and technology, we discussed that briefly just before this, and you're pointing out the need for large scale data. Uh, Also, this sort of computational focus, if you will. But I think there are three things that I wanted to sort of think about. One is how what data do we handle? I mean, data management, of course, the technology is getting better and better, and so we can scale vast amounts of data. But the key issue is the right data available? Is it available at the right price? So
That's the
I just
challenge.
wanted,
That's it. That's
yeah,
exactly the challenge. It's more and more external data that people have to use, unfortunately, because it's not in the policies, it's not in legacy systems. That's why providers and also like financial providers think about how can I be flexible in terms of attaching new data and being very lean in my core system, so that I can adapt to new data sources and data quality issues and things. And data should also be economically efficient. It's like you cannot collect all data for just like some minor decision you are making. So all these things are in the minds all the time. And who knows what we need in 5 years or 10 years? No one really knows that. So you have to stay on a flexible platform. That's the and on lean projects, not heavy projects, long year projects, and then you end up in the jungle and have not really reached anything. So that's a quick final note on the data and systems.
Oh no, thank you. This was very interesting, and Marcus, really, you brought out the the surrounding issues around the whole pricing optimization issue dynamic, if you will. You can have the best algorithms, you can have machine learning, which enables you to do a lot of nonlinear analysis, nonlinear optimization, etc. But you need the data, you need the technology, and you need also the understanding of the space to understand where you should hit your sweet spot, because you don't want to be making it constantly changing, or you want that right balance, if you will. So with that, I close and thank you very much.
Thank you, Sid. It was a pleasure.
Thank you.